And with the end of the year quickly approaching, many Canadians are taking a closer look at their finances, from investments and taxes to important deadlines that could impact their bottom line. Joining us now is Brendan Caldwell, director at Caldwell Securities Limited, to break down what you should be thinking about before December 31st and how a few smart moves now can set you up for a stronger financial start in the new year. Brendan, thank you so much for the time today.
Thank you. It's a strange thing to think that at the end of this month, the 21st century will be one quarter over. I don't know what we've done with it. I don't know where the time has gone, but like an entire century that seems to have just started in my brain is a quarter over, and I'll be lucky to see the halfway mark.
Well, let's focus on what we can actually focus on come the new year. So, what year-end financial tasks should people be doing right now?
Well, I think it's a good time for taking stock of where you are and what you've done. Now, this time of year and the early part of 2026, people think about tax planning, RSPs, tax-free savings accounts. But there are other things that one can do in one's portfolio. And I think if there's a New Year's resolution to be started, it should probably be think about doing it in December rather than on December 31st or January 1st, because the resolutions made at the very end of the year tend to get lost in the haze of a New Year's party recovery. So I think the best thing people could do right now is to resolve however much money they're putting aside every month. If it's $50, make it $75. If it's $75, make it $150. If it's $500, make it $600 a month. Whatever you can just slightly afford, I would up that just a little bit so that one's savings continue to grow at an accelerating rate. People still take loans for RSPs at the turn of the year, but I think much better to save just a little bit every month if one has the capability of doing that. And that would be, I think, the first and best recommendation for most people right now.
And what exactly is tax loss selling? How does it work, and what is the deadline for 2025?
Well, it's a funny thing. So in Canada, we work on what's called settlement date. Now, in the beginning of my career, the difference between the day a trade was made and the day it settled was actually 5 business days. So to take advantage of tax loss selling back in the day, you had to sell before New Year's Eve. Nowadays, you need to have sold, and the trade needs to have settled by the end of the year. So it's now just next day settlement. So long-winded way of saying between now and the 30th of December, not the 31st, but the 30th of December, one can sell stocks or other assets on which you have a loss and claim that loss against gains you've had this year or in previous years, or you can carry forward those losses pretty far, if not indefinitely, into the future. So up until the 30th of December, one can sell stocks on which there is a loss. Now, the flip side, the interesting thing of that, knowing that stocks that have been under pressure this year will probably be under more pressure in December, you can do what's called tax loss buying, where if there are stocks that you would like to own and you know that people are going to be selling because they've already been selling through the month of December, any stocks that are already down, it's probably the best time to buy them because they're the most likely to have a pop upwards in January, because anybody that would have sold those stocks would have already done so in December. So anything that's really taken a hit that somebody likes potentially as an investment, worth taking a look at in December, not necessarily to sell in January, but with a much higher probability that you're going to have a bounce in that stock next month.
And in your opinion, is this a good time to rebalance your portfolio?
It is a good time to take stock of what you want to do with your money next year or in the next couple of years. All money is meant to be spent. By spent, I mean used for something, invested in a house, used for travel, given away, given to your kids if my parents are listening, whatever. Not given to your kids if my kids are listening. But I think it's worth figuring out how you want to use the money. And then from there, like if you know you're going to have a big expenditure in 2026, then I would suggest raising the money now, or at least aim to raise the money over the next little while. It's always better to raise the money when you need it, or when it's there, when it's available to be done easily. If you wait until the moment the market collapses, and that's when you're going to have to pay for that house or for that car or for whatever that is, it's much better to have done it in advance. So rebalancing in the sense of raise cash now with a view to your 2026 expenses. I think it's also probably worth looking at what is done well and what is done badly. And much like what I talked about in terms of the tax loss buying, it may be worthwhile shifting from the things that have done well to the things that have done badly, if you still like them, if your thesis, if your reasoning for owning them is still the same. Because everything reverts to the mean and nothing goes up in a straight line. What I mean by that is the thing that you thought would do well that actually did kind of poorly this year will have its day, and maybe its day will be in January. The thing that you are kind of surprised did so well, yeah, it's going to come back down again. So using a chance to rebalance now might be an opportunity to buy a little bit more of what should have worked but hasn't yet, and maybe trim a little bit of what outperformed.
And what are major deadlines that we have to be cognizant of?
Oh, well, for those parents that are saving, the RESP deadline, it's a bit of a soft deadline because you need to have made your contribution for this year by the end of this year. It's the home buyer's savings plan, I believe, works the same way. So the year in which you're doing it is the year that the contribution's for. It's not like our RSPs, registered retirement savings plans, where you can carry over. And I think the deadline for RSP contributions to get a tax deduction in 2025, you can make those contributions up till, I believe, March the 2nd next year, March the 2nd, 2026. So for home buyers savings plans, for tax-free savings accounts, for registered education savings plans, you do need to make for this year those contributions in this year. Now, all three of those plans have the ability to carry forward. You can make up an RESP contribution going back a year. But since most people tend not to think about it until the kid is 9 or 10, it might be worthwhile just keeping as current as you can, just so that you can make all the contributions and get all the government grants, in the case of the RESPs, by the time they're 17.
Now, Brendan, we have about a minute left, but is there anything else that we should think about regarding our financial tasks as 2025 comes to an end?
Don't panic. At some point, this ridiculously strong bull market, this very strong market, is going to correct. It will. It always does. And it may be something predictable, or it may be something that comes right out of the blue, like COVID, God forbid. But have your investments in such a way that if, as and when there is a pullback, you go, I guess this happens. Is the Western world collapsing? No, then I'll be fine. So raise the cash, put your affairs in order that you have the money that you need available for what you reasonably expect to need available in 2026. And then add a little bit more to your savings, because even if the market does correct, if you're dollar cost averaging, for doing a regular contribution, that's going to stand you in good stead for years to come.
Well, Brendan, thank you so much for the time. We appreciate it.
Thank you, Theresa.